All right, we'll let everybody jump in here quickly. All right. Hi, everybody. Thanks for joining us for the investment webinar on Waterpark at Briarwood. We appreciate your interest in this opportunity. And as we have stated, there are limited allocations in the deal. We have about $1 million left to raise on this, and we'll be looking to close on September 30th with funds due by September 26th. Dennis, our Chief Investment Officer, is going to update everybody on this deal and provide some additional color on the investment opportunity. And we will open up a Q&A box. I will populate that here in just a moment, where you can type in your questions that we will answer at the end of the webinar. So we'll let Dennis present, and then we'll do the Q&A. And without further ado, Dennis, I'll let you talk a little bit more about Waterpark at Briarwood and why we're pursuing this deal.
All right, great. Thanks, Laura. Have we let everybody into the lobby that's trying to get in?
Yes.
Okay, great. Well, thank you everyone for joining us today. I know some of you are already invested in this deal or invested in the fund, and this acquisition has been a labor of love and pain. I can say without question, I have never had a deal tied up longer without closing, which has been a frustrating process for us internally. I'm sure frustrating for some of our investors too. And just to give you a little bit of background on it before we begin, essentially we were teed up and ready to close, but unfortunately the seller had a couple conditions of closing that they weren't able to remedy in time. We were going to do the deal originally with the CMBS lender, who is very time constrained by putting our individual loans into larger securitizations. And once we weren't able to do that on time, we got kicked to another securitization, at which point we had problems with some of the potential B buyers who were asking. B buyers are the ones who take kind of the riskiest slug of a securitization, and can kind of control the terms of the loan even beyond what you've signed in the term sheet. And so we were getting some non-market terms asked of us by the B buyers, which didn't make sense for us, or certainly for you guys as investors. And then ultimately we decided we couldn't proceed with the CMBS lenders. So we went and found a regional bank, which frankly we enjoy working with much better than some of the larger Wall Street banks and CMBS lenders. And we're able to procure favorable terms. But as you may have read already, our LTV went down slightly, so we've got to pull in some more equity to the deal, hence why we're re-presenting this deal to the market. So with that, just a quick disclaimer, this webinar is only for informational purposes only. We're not actually constituting an offer to buy any security with us. Anything in that regard would be made through our private placement memorandum. Please note that this opportunity is only for accredited investors as well. And thank you all for joining this call. This is part of an extensive list of due diligence that we recommend that any potential investor takes in this deal, or any other deal for that matter. Quickly about us, I know we've got a couple first-time potential investors with us. So our focus at Sentinel Net Lease is really to buy stabilized single-tenant net lease deals at opportunistic pricing. And so we've been pretty successful doing that so far. We've acquired almost $340 million worth of properties across the U.S., across 14 states. We've been able to always use accretive debt when we acquire our acquisitions, which helps us produce above market cash-on-cash returns from the lease income alone. And we've been very successful on those investments that we have exited, which have yielded on average a net IRR of 28%. I think one thing you'll learn about Sentinel, if you don't already know, is we really pride ourselves on transparency and utilizing technology to improve not only our experience as an investment manager, but your experience as passive investors as well. For that, we've been awarded by many different publications for the company we've built. And just to tell you a little bit further about that, Not only do we have a great internal team of top-notch, institutionally trained professionals, but we rely on a great third-party support team, including some of the top attorneys, tax advisors, property managers, leasing brokers across the country to really try to deliver best-in-class results for our investors across our portfolio. So with that, let's get into the investment opportunity of Waterpark at Briarwood. This is shorter than what it may seem long to you, but this is going to be shorter than our traditional webinars. I realize that there's a lot of information that you can just review on your own time when it comes to looking at photos of the property and reviewing some of the more detailed market data or the lease terms beyond a high level. So we're going to strip a lot of that out so we can really get through this in an efficient timeline and then answer any open questions you may have. So really going down the top things that we like about this opportunity. So number one, Waterpark at Briarwood. It's located in Centennial, which is a great high-quality suburb in Denver. Obviously, Denver's been one of the fastest growing metro areas in the country for decades. And Centennial really carries on that tradition of having highly educated, high earners, high quality of life, great education, low crime. So we really like the location of this property. Looking at a couple of the economic elements, it's great. This really fits within our current investment criteria of trying to find high quality properties where they have a tremendous amount of lease term remaining, in this case, a little over 11 years remaining, and projected cash on cash returns that can beat the general market. Here we're showing that we're starting off year one at over 10%. These properties are double net lease pluses, so nearly all of the operating expenses are passed to the tenant, which really reduces our exposure and creates a consistent level of cash flow and distributions to the investors. Another nice element about this is that these leases that are in place that were structured by the existing owner are well below market. So while we're happy that we've got the tenants in place that we do, when it comes renewal time, if somehow we still own the asset, or if one of the tenants was to leave, we've got a pretty tremendous lift potential in NOI through setting that the leases and marketing them to market. We've also spent a tremendous amount of time with the seller to create credit enhancements around this deal, and we'll talk about why that's necessary, but it's equated to over $3 million in seller-funded credits to offset not only set future costs to capital expenditure items, but also potential risks like releasing the property as well. So we're really trying to solve for any potential scenario up front. So a lot of negotiation and work went behind that, but really adds a ton of value and lowers the risk overall. Great mitigants from my perspective. The buildings themselves, they're Class A flex space. So, you wouldn't get these buildings confused with a mid-rise or a high-rise office building with 100 tenants. Both of them are two-story buildings, concrete tilt-up. A lot of this kind of product is not built anymore. If it's built like this, it's just built purely as industrial. So it has a really unique position in the market, which I'll get into a little bit later. But at our acquisition price of just over $150 a square foot, it's a steep discount to any flex office building of a similar nature. But considering some of the improvements that have been made on site on these properties, it's quite substantial. Also, we're obviously acquiring this at an attractive cap rate north of a 9%. And as I mentioned before, we were able to procure debt from a regional lender with an interest rate below 6%, which frankly, we were pleasantly surprised we were able to obtain that. Our previous estimate on what our interest rate would be was 7%. So some good savings there and good work from our capital markets team finding the right type of lender for us. Both of these buildings are single tenant buildings. The two tenants, Biotechne is a very large biological sciences company. Quantum is technology focused, especially on data storage. Uh, we'll get more into the details of those companies. But what is nice for you as investors, because both are publicly traded, although we make the financials available for you, you can obviously do more research on your own for this than some of the private market companies we acquire occasionally. One of the most compelling elements of this deal, when Quantum and Biotechne came in, not only did they spend a lot of their own money, and the tenant also funded some money, totaling $16.6 million. So looking at literally more than 65% of our purchase price was spent in just recent improvements, including massive spends on power heavy HVAC, improvements in power capacity, cold storage lab space, and both buildings have substantial IT build outs. And as I mentioned before, these are both long-term leases. Biotechne is leased for nearly a full decade, Quantum all the way through 2037. We'll get into the returns a little bit more detail when I show you the financial summary, but just so you know, at a high level, our projected net IRR is 15.6%. Our multiple on invested capital is a 1.8, and we assume we're going to hold it for 5 years. It's important to know, if you looked at our investment summary before, you would see that the net IRR was about 300 or 400 basis points higher. That's not because anything in the deal changed. It's really a function of, as Sentinel, as an operator, as an investment manager, we're starting to bring in a different clientele of investors beyond retail investors. And so now we're working with pension funds, wealth managers, and a lot of the gatekeepers and consultants for these companies are just naturally more conservative. So even if they agree with our assumptions, they want us to cut a lot of those things by 20% to cover a what if scenario. And so because some of those groups are looking at that deal, we just felt it was best to be transparent and show that to everybody. So nothing has materially changed in the deal. It's just a function of more conservative underwriting, which I'll share as I get into the presentation. This is something I've shared with our investors in the past. The way that we underwrite our deals, we have these 6 pillars that are our underwriting framework. What I haven't shared with you before, and I'm happy to share now, is we have really built this out to a level on par with the largest institutions in the world. And I can't show you about 80 pages of backup material here, but everything is now on a standardized scoring system when it comes to these pillars. And so we're looking for deals that, if they're rated 7.5 or above, when we look at a weighted average of the scoring of these pillars, it's kind of a no-brainer. Ideally, it's above a 6. But we'll look at deals that are all the way down to a 4.5 to a 6, assuming there's some type of mitigating factors that make it make sense. Anything below 4.5, it's a quick pass. And as most of you that know that have invested us within the past, we look at thousands of deals every year, and we're lucky if we buy 2 or 3 or 4. So we're extremely disciplined on that front. What I am going to share with you that's new here is really how our scoring works and how deals are actually rated relative to our minimum standard across. So as I mentioned, the 6 pillars: tenant quality and credit, lease structure and duration, location, building utility, relative value of the investment itself, and the overall asset quality. So we don't assign just a score to each of these pillars. There's actually 39 different submetrics across these pillars that are each weighted based on their relevance to the investment. And that comes up with really a score for each of the pillars that is weighted. And then each of these pillars is weighted to come up with a score across the board. And so you can see with Waterpark, the minimum that we'd really try to go for is 5. We beat that soundly across the board. The weak spot, in our opinion, is the credit, and that comes down to really Quantum, as we'll go into more detail later. But as for all the reasons I mentioned previously, long lease term, great location, great build outs, excellent basis relative to the price. institutionally maintained property with a tremendous amount of improvements. It really checks off all the boxes we're looking for in investment. So we do this for every deal we acquire, and there are reams of data behind it. A lot of it is proprietary, so I can't share the actual numbers behind it deeper than this. But I'm happy to walk any investor through the methodology so they understand how we do it, where we get our data from. So really proud to share that with you guys now, that really is our standard bearing going forward to provide more transparency, not only for us internally, but for you as investors as well. Quickly looking at the property information, I mentioned to you it's in Centennial. That's in the southeast of Denver. You're about 30 minutes or so from downtown. You're about 45 minutes or so from the airport. It's got great access to major freeways. This area has a huge amount of science, technology, engineering, aerospace. So we love that base of educated tech-forward firms that dominate this area. Has a lot of single-tenant office concentration here. And giving you a little color on the office market here, we obviously have data in the investment summary, but we're unique in this submarket here. So because we have this flex office that has differing uses like lab space or data centers, even some distribution space, medical office, a lot of different uses in that flex category. So in our submarket, there's 267 buildings that have that flex designation that total about a little over 9 million square feet. The vacancy rate for this product in this submarket is only 8.3%. So the Denver overall office market vacancy is close to 30%. So this product, they're not creating a lot of it. There's been very few new supply added. And because of that, the vacancy rate has stayed consistently below 10% for over a decade. And to speak to exactly how little of this product they're building nowadays, the average Class A building was built in 2003. And just a little extra color on rents, as I think you may have seen, our rents in this building are in the $13.50 per square foot range. Average Class A rents are at $15.50 across the entire submarket. And if you look at new leases being signed in 2025, the average is closer to $18.50. So again, a substantial mark-to-market opportunity for us at some point in the future. Just quickly giving you a look at the site plan here. Like I said, two separate buildings that are essentially mirror images of each other. If you see that little sand pit with the circles down to the south of that, actually to the west of it, that's Topgolf. So we're in a nice area that's highly trafficked and close to freeways, as I mentioned. We've got very strong parking ratios, totaling nearly 750 spaces, so a parking ratio of 5 per 1,000 square feet. That's 25% higher than what most tenants are looking for nowadays, which is great. These buildings were built in 2000 and 2001 and underwent a substantial improvement renovation in 2021. Going into the financial summary. So like I mentioned before, we are going to use a regional bank at 55% loan to value, meaning we're going to pull in $11.6 million of equity on this deal. Our plan is to hold it for up to 5 years. The general business plan here is that we think at some point between years 4 and 8, maybe it happens sooner, maybe it happens later. We just think interest rates aren't going to remain at this elevated level forever. Cap rates could compress, and that's a good opportunity for us to offer an early 5-year renewal to both the tenants, which would essentially bring the WALT to where it is now. Now, if we were able to get an extension earlier than that, great. That means even more WALT in the market, which would mean a lower exit cap. But what we like about this deal is it produces a very strong cash-on-cash return, regardless of when we sell it. The debt, as I mentioned before, is highly accretive at only 5.8%. That's interest only for the first 2 years and then amortizes over a 30-year period after that. And then we would potentially refinance at the end of year 5 if we were still holding onto the property. You'll also notice, as I mentioned before, that we're getting a seller credit of nearly $3.3 million. That is attributed to a holdback for us to make some capital expenditure improvements over time, as well as potential releasing cost in the event that Quantum defaults, files bankruptcy, leaves for any reason before their lease is up. And so overall, we're expecting this for very conservatively to produce a 15.6% net IRR to the investor, a 1.8 equity multiple. One thing that I will mention here as I move to our sensitivity matrix, you will see that our disposition cap rate is 8%. So only 100 basis points of compression from where we are today. It doesn't take a lot in the capital markets to get that level of compression, and I think you'll find that that is on the conservative side of what you will see with a lot of investments today. Previously, we thought we were going to have more compression, and so our original estimate was 7.25%. And if you look at this sensitivity matrix, you can see obviously the net IRR is 18 under that scenario. Versus the 15.6 now. And that's really been the primary mover of the change in projected IRR is just we are being more conservative on the exit to fall in line with more of our institutional type investors' projections. Okay, here's the alternative scenario. The alternative scenario assumes Quantum defaults in year 3 of our hold period. Now they could default at any point. They could default 9 months from now. We're not sure. Now, they've been in the building for 4+ years, and they've never missed rent, and the company's been around for 45 years. But there are some financial issues they're working through right now that I'll get into more detail. But we really try to be thoughtful in our approach to understanding what is the downside to any deal. So in this scenario, if they do default, the benefit we have here is we've got millions of dollars in reserves to cover those costs, which we think will be about 1.7 million in terms of tenant improvement allowance, leasing commissions, and free rent to bring a new tenant in. But additionally, and really beneficial to us is we mark to market that rent from $13.50 to $18.50, and you can't see the end result here quite as well, but basically once it's stabilized with that new tenant, the cash on cash improves dramatically because of that higher NOI. Because these are just year by year, it doesn't show exactly when that new tenant comes in as if it was month 1, but the new cash on cash return for the investors once that new tenant is in place at that higher level is over 14%. So quite a big lift from what we're starting at now. And that obviously helps us in terms of what our exit price would be on the property. Now, again, we are being extremely conservative here. Now we're assuming that the cap rate is 9%, which is what we paid for it, even though in theory we would have a higher caliber tenant from a credit perspective if we replace Quantum with, just about anybody. So just important for you to note that we are considering this. We think there's about 6 months of downtime at the property as they vacate and as we have to do a build out for the new tenant. I'm going to go into a little bit more detail on what that would look like if Quantum defaulted at any point in time. But the good news there is we have the capital for it. We're prepared for it. We've already spoken to the leasing brokers that lease these buildings out, and we're leasing into a very strong market that has low vacancy and elevated rents. So not that you ever want to celebrate a downside, but this is extremely conservatively underwritten as our downside, and it still generates a net IRR of 13.6%. One other thing on the financial side I wanted to share with you, this is a happy benefit, I guess, of the deal not closing earlier. Trump's passage of the one big beautiful bill. I hope that's right. Um, the that has brought back in 100% bonus depreciation, and so you can see from here, the white line where it's flat is without using any cost segregation. The blue lines are what it would have looked like before with limited bonus depreciation, and the red line where you can see the year one up at $4.5 million is what it looks like. Our projection looks like now with 100% bonus depreciation. And so what does that mean to you as an investor? Well, let's assume you were going to invest $100,000 into this deal. You're going to get 3 months of distributions, assuming we close at the end of September. But you're going to have a huge amount of theoretical losses because of this accelerated depreciation. So even though you invested $100,000, your K1 for year one would look like you lost $37,000 because of the depreciation. So it's a good way to offset other K1 income as well. Okay, going into the tenant overview. So we don't have to spend a lot of time on Bio-Techne, but multi-billion-dollar company based in Minnesota. Novus Biologicals is one of their subsidiaries. Their headquarters at our property, and the parent company Bio-Techne is starting to use this facility for a wide variety of corporate uses, including annual sales summits, things like that. This building has cold storage and lab space on site. It's also their global head of IT is based in this building as well. Like I said, very large company, been publicly traded, been around for nearly 50 years. They don't have a current credit rating because they don't have any current corporate debt outstanding. One thing that Sentinel does, whether you knew it or not before this, is we shadow rate every company to come up with an estimate of what we think their credit rating would be. And it's an exhaustive process with dozens of different indicators to come up with this. But Bio-Techne, their shadow rating based on our analysis is an A-, which is investment grade. We're ecstatic about that. Looking at Quantum, they're at the other end of the credit scale, but they are really in a unique space right now. So they are in data storage, data protection, and looking for scalable and cost-effective storage solutions beyond the cloud. So, utilizing data on the cloud is expensive to maintain, especially if you don't need information in half of a second. And so, their clients are all across the board, but it includes a lot of household names like the FBI, the Department of Defense, large municipalities, the NFL, Major League Baseball, and a lot of these groups are ones that store literally hours and hours, countless hours of video footage, and don't want to pay for it on the cloud, but still want that backup and accessibility somewhere. And so part of Quantum's product offering are these super dense hard drives that can then basically be accessed via their own custom robotic arms within the server racks, so that not everything is accessible instantaneously, but as they need something from their archives, this robotic arm can go and find it. It is really fascinating technology, and they are on the cutting edge, especially as you see the advent of AI go more and more, but people are looking at the cost centers around it. They're looking for ways to build out these LLMs and generative AI without breaking the bank on data storage. So now the downside here is they have some really cool technology, but they have a hard time consistently making money, or at least being profitable because of how capital intensive this business is. So I want to talk about that a little bit. Like I said, you can see the full financials for the companies within our investment summary, as well as what's available online. But at the end of the day, Quantum has financial problems. Their revenue is relatively consistent, but they are having a hard time turning a profit consistently. And so, from a credit perspective, it's our opinion is it's a junk rating. It's triple C. But as an investor, how do we mitigate that? Well, what we do is we acquire the piece of real estate that they can't do business without. And then we make sure that we have credit enhancements beyond that to cover our butts in the event they do default in any capacity. So I'm going to talk about that a little bit. We had a couple of investors that asked some great questions um, about quantum and kind of what would happen in the future. So, Quantum currently has a going concern about it. And for those of you that don't know, it basically means that, look, they're not filing bankruptcy, but they're letting investors know that if they can't fix some of the elements within their existing capital structure, whether they're refinancing existing debt, changing some of the reserve requirements of their lenders, they have the potential to become insolvent. Now, here's the good side. Quantum's been around for 45 plus years. They've had credit stress before, and they've been able to navigate it with amendments and waivers from their lenders. There's not a lot of debtors that want to jump into a technology company and try to figure it out. So they're working on that now. One thing that they've done to bridge the gap is they entered into a standby equity purchase agreement with Yorkville Advisors. And so that gives the company liquidity over time to bridge the gap and, give the some of their lenders that they have access to capital as long as they can play ball with them on potential amendments. So what are we doing as potential owners of this property? Number one, we're constantly paying attention to the financials they put out, so we understand what their liquidity looks like. Are they violating any of their loan covenants? Are they getting waivers when needed? Are they renegotiating on their debt? And trying to understand what their revenue pipeline is looking like going forward. One of the things about Quantum is they've really done a good job, although it's hurt their balance sheet over the last 18 months, is they've killed a lot of their older products that were just not profitable and where the burn rate was just too high with diminishing margins. And so by focusing on the next generation of products, especially a lot of recurring revenue subscription model businesses, they're getting good momentum there, but it takes time. They've also consolidated a number of their operational centers, and so actually our property at Waterpark benefits from that. They've consolidated their global IT command center into this property. All R&D and testing is done at our facility. And when we had an interview with the CFO, he said quite bluntly, we cannot function as a company without this building in Centennial. So as we look going forward, what are we going to do? What does our playbook look like in the event that they don't do well? We're paying attention constantly so that we understand where they are at with their lenders, where they're at financially, making sure that the brokerage community understands that this might be available sooner than later. The benefit we have here again is that this is a data heavy, lab capable building that is unique in the marketplace. And so, we know the risk is there with Quantum, but we think the big mitigating factors are you've got the mission critical nature of the property. We're acquiring it at an extremely attractive basis. And to give you a little more color on that, like I said, we're buying both buildings for $155 a square foot. The two other buildings at this business park sold for nearly $180 a square foot in the last 12 months, and neither of them has any of the improvements that Quantum or Biotechny has. And there are more high quality improvements in the Quantum building than there are in Biotechny. So we really like our basis there. And again, we have those reserves to be able to execute this potential alternative business plan in the event they default. So going in more detail, questions around, well, what if Quantum goes bankrupt? What does that look like? I don't understand corporate bankruptcy. That was a question from an investor. So the way this works is basically from the day that they file, they have 120 days. It can be extended slightly more than that if required, but generally they have 120 days, and then they need to either reject or assume/accept the lease. And if they accept the lease, then everything goes back to normal. They might get a small grace period where they don't pay rent for a couple of months. It literally is only up to 60 days, but they still owe that amount. So once that grace period is expired, they have to catch up on the rent that has accrued. And so if that happens, we think obviously the chances of the court accepting the lease is much higher because it's a mission critical place. How do the creditors really, have a chance of getting any type of real capital back if they're shutting the one thing down that makes the company money? So we think we're in a good position for a building like this to certainly stay open more than a back office or a normal corporate office that doesn't have any actual technical functions to it. So, like I said, if the lease is assumed, great. They just have to provide some type of adequate assurance that they're going to continue to perform in the future. If they don't, if the lease is rejected, they have 30 days to give the property back to us. And if it takes them longer than that, we get paid by the court for them being non-cooperative. What's important to note there is the vast majority of the $13.5 million in improvements that Quantum made to the property, it stays with the property. So we have high power capacity, high HVAC capacity that is not typical in buildings of this age because of its specialized use. And it really opens us up to a different level of user than a traditional flex office building. And I'll talk about that in a second. So they surrender it, within 30 days. And then, what do we need to do? It doesn't take us a lot of time to get this ready. It's really just a few weeks to, test all the systems, debrand the building, go through cleaning and mark it up for sale. So the time to lease from the first showings, optimistically 3 to 6 months, given the tight vacancy in that market and the unique usage and utility of our building. Base case 6 to 12 months, downside 12 months or more. The build out after signing the lease should be 1 to 3 months, depending on how specialized some of the build out is. But a lot of this is really move-in ready, because the improvements were made, especially to all the office space on the second floor. It's spec suite ready, so we're not expecting a lot of tenant improvements needed. Looking at some of the economics of that releasing, as I mentioned before, the new rent for Class A Flex in that submarket is $18.50, so that's kind of our floor. However, because of the heavy power and elevated AC HVAC systems we have, in theory, we could be getting $27 plus per square foot if we attract a user like that. Now, we're not underwriting that in any scenario. That's just what the leasing broker let us know, that, hey, you have a unique opportunity here in the market because you can offer something that is really in short supply. The tenant allowances are fairly de minimis, only $2 to $3 per square foot per year. Leasing commissions are $1.25 to $1.50 square foot per year. And we think for a 5-year term, we'd only have to offer a 3 months rent abatement. So all of that is factored into our underwriting. Hope that answers as many questions as possible about Quantum. That really is the big question mark in this deal, but it's something that we've tried to account for from day one and continue to keep an eye on. To finish up, the investment terms of the deal, very standard stuff, and you can review this on your own, but just again, to be clear, the minimum investment is $50,000. Our fee schedule is here. And then we use a waterfall schedule where there's an 8.5% preferred rate of return to the investors, and then a split that starts at a 75-25 all the way up to a 15 IRR. And obviously, as we perform better, our stake in each section of that promote goes up. And the obligations are very similar. We pay the lender, we pay our asset management fees, we pay the preferred return, then we return equity if we're above that, and then we split the profits. Very straightforward the way all of our other deals have worked. And with that, I will open it to questions, Laura.
Yeah, great, thanks. So we have a couple of questions, and Dennis, I can help you out here on some of these if need be, but let's start with, on the deck, we talk about a 10.3 cash on cash return, but then we say we're doing an 8%, we plan on 8%. And I think, we can allude to that because this is a joint venture with the fund, and there's two different classes in Sentinel Opportunity Fund 1, with the pref being 8 or 8.5%. In Waterpark Fund, it's 8.5%. So anything paid above that would be considered a return of capital. I don't know if you want to expand on that anymore, but that's what that is on the cash on cash. So the cash on cash is just a projection, but we have a distribution schedule because of the joint venture with the fund. Another one.
And for an investor that doesn't understand that, it's really just a way for us to de-risk you above that, right? So if you're above that preferred rate of return, it's lowering your capital base over time as well. It's pretty simple way and very standard.
And another one we get a lot, 1031 TIC availability. We're only raising $1.6 million here in this deal. So I think for the cost of doing a TIC, it would have to be, we would like to do larger opportunities than that. I know we've looked at some previous deals and we have done that before, but this is a smaller raise. So I would say probably more than likely not 1031 compatible.
If we have a lot of 1031 investors out there, I would suggest we schedule a separate call and we can create either a TIC or a DST among them for a similar type of opportunity where the check sizes and the formation costs make more sense.
Yeah, agreed. And then also a little bit more on the debt. The deck stated it was CMBS. Obviously, we've switched now to a bank mortgage, and the question is why the $3 million initial reserve requirement, and how's that being funded?
The reserve requirement is actually just a depository requirement, not a reserve requirement, but it's being funded from the seller credit. It's very simple. We're not taking any additional equity in to fund that and just sit on it in a high yield account. But we want that seller credit to be available to us. And so we were working towards that with the CMBS group anyway. So we already had that money allocated. So it just makes sense. The last thing I want to do in a deal like this that has a potential downside is to go do a capital call or suspend distributions or anything like that. We have the extra cash from the seller, and we should, I think, reserve it accordingly.
Yep. There's a question on the catch up for the GP. There's no catch up for the GP in this deal. So that doesn't exist for us. I know that's in a couple of other deals, but that is a benefit here that there's no GP catch up.
That is what happens when you actually are able to current pay the pref.
Yes. Couple of other questions related to Quantum. So I think you covered this earlier. They are current in their rent payments, but do we have historical? Have there been any defaults on rent historically?
No defaults on rent. We have their entire history. They pay like clockwork.
And then on the plus side, let's say Quantum remains a going concern. That $3 million that's held for reserves, how does that get distributed amongst the investors? Just at the sale?
That is part of the upside here if Quantum can continue to perform, or if they, especially if they actually improve, their credit structure or financial structure over time. Yeah, there is a certain amount of money that is earmarked for that releasing cost, and if we don't have to release then that money just gets back when we exit the property to the investors.
And on a releasing opportunity, would this building be would you look to multi-tenant this, or is this a single tenant user?
Ideally, it's single tenant because of the unique setup of office on the second floor with a little bit of lab space, and primarily data center on the first floor. But it really all comes down to what the broker tells us. I will tell you, because data center rent is so high, if we found a data center user that wanted to lease just the first floor, we would take that all day long because the rents for purely data center are double at least where we're at 1850. So we would lease them the first floor, and then we would go, lease the second floor office to somebody for a very attractive rate because it's spec suite ready, and it'd be a win on both fronts. But we're gonna cross that bridge when we come to it. And ideally, in any of these buildings, we're looking for a single tenant first.
Right. And then a couple of questions on the lender. As you mentioned, it's a bank. If we can disclose that's a question there. And then there is a term sheet signed. This has been through loan committee. They have done, I would say, Dennis could agree with me, the bulk of the due diligence that was needed. We were able to get that to them quickly, hence the swift closing date.
Yeah, I'm happy to share that just because this has been such an odd transaction from a financing perspective. So the lender on this is called Kirkpatrick Bank. They're based out of Oklahoma. They've got branches in Colorado. Their commercial real estate division is been very easy to work with so far. The benefit of that so far has been their acceptance of all the legwork that's been done. So they accepted the CMBS appraisal that was done on behalf of UBS. They accepted our property condition assessments in phase one. And as Laura mentioned, this has already gone through loan committee and has approval, and they're ready to close as fast as we are.
Yeah. And then, do you know, I think the sale of those other two buildings, those were to owner occupiers, correct?
Yes, yes, those were two owner users. One of those buildings used to be occupied by Biotechne, actually, but they expanded into a larger footprint, which is why they moved into the larger building that we are now acquiring. But the build out of neither of those buildings is anything special.
Yeah. And then just to touch again on, why, even though given Quantum's credit and our typical investment, we're always looking for that quality credit tenant, how does this align with our investment objective, and sort of, does this do anything down the road to when we go to sell it? Let's just say if Quantum is still in, obviously we want their credit to get better, and obviously their management team thinks that they can do that. But sort of talk maybe a little bit more, Dennis, why you like this deal, even though Quantum is speculative on being a tenant long term.
It really comes down to a couple things. Number one, somebody is already paying us to take on Quantum's risk with the reserves we're getting from the seller. Two is the basis for this property relative to the improvements in it. If I wanted to go rebuild the Quantum space right now from the ground up, it would cost me $450 a square foot with all the HVAC and power enhancements they've done. We're buying it for $150. And obviously, as you guys may know, from an internal allocation perspective, we don't view Quantum and Biotechne the same. So our internal allocation to Quantum is closer to $120 a square foot. So we really like our relative basis on that property, and the fact that we already have the capital reserves to go effectuate an alternative plan, get a mark to market on rents, potentially get a stronger tenant in place, and improve NOI. I think it's a very good story that, while not the same coupon clipping deals some of you like and are used to, there are so many great mitigants and a narrative behind it that makes sense, that we think it still fits within our strategy.
Great. And then, lastly, Dennis, if we could touch on those that have been with us since March, wanting to know, how their pref is being treated, versus, folks that'll be coming in to the new 1.6 that we're raising.
Yeah, I think you could probably get a better statement from our accountant or our COO than me, but the pref has been accruing for the investors since day one. That doesn't change. That affects us as your investment manager about it taking longer for us to get into the promote. But we want to be aligned with you. Frankly, it's frustrating for us because we were instructed to make a capital call by the lender, even though the lender didn't have everything they needed from the seller. And so it put us in a very awkward position, where obviously we made a capital call, and yet then our lender wasn't ready to close because of conditions not met by the seller. Never happened to us before. Never had we been instructed to do something and then kind of get turned around that way. But it is what it is. And once your money sits with Sentinel, it's earning. Whether we put it out to work or not yet is not your concern.
Great. I think that wraps up all the questions I have right now. My email is on here as well. Many of you and I have already spoken. I'm available to answer any questions. Our investment process is very simple. If you're not currently an investor, we can get you set up on our portal. It's your private portal where you can set up all your investment entity data, and then it's a e-signature process. After that is done, we will do accreditation verification, which is all done by a third party. We don't do that in-house. You'll get a secure link where you'll be able to upload your documents. North Capital will do the accreditation, and then if you need your accreditation letter for anything else, they're good for up to 3 months. We will upload them to your portal so you can draw those down whenever needed. And then we pay quarterly. So obviously with the close of September 30th, we will be looking to make the first distribution within 45 days of the close. It may vary just given that we're closing right on the 30th, but we'll keep you posted on that. And it's all direct deposit into your banking account that is in your portal. Again, if anybody has any questions, I am available. Dennis is also available if we need further conversation, but we appreciate your interest and look forward to getting this deal across the finish line.
Thanks, everyone. Appreciate your time.
Thanks for your time.